So I think now I should start, right? There are around 80 students. Now people will join in. We have waited for 10 minutes and now I'm starting. So good morning, everyone.
Morning, sir.
Good morning, sir.
Good morning, sir.
Morning.
I hope you enjoyed the last lecture. And before I proceed further, I would like to invite if any queries are there from the last lecture, and then we will proceed further. Yes, if you have to ask anything from the previous class, you are welcomed. Otherwise, I'll start further. No queries? Right. So, if you remember in the previous class, we discussed the scope of financial management. And in scope of financial management, we discussed investment decisions. We discussed financing decisions. We discussed dividend decisions. These are the three major key areas where the financial manager of any company has to take decisions. This we also know by as scope of financial management. When the manager is taking investment decision, these decisions could be long-term decisions, or these could be short-term decisions. If these are long-term decisions of investment, they are known as capital budgeting. Shorter, they are known as working capital management. We discussed that under financial decision making, the companies take the decision regarding the debt equity mix. We are assuming, and we will assume throughout the study period, or during the classes, we'll assume mostly, unless otherwise specified. There exists two types of funding source. One is, rather I'll say, two types of external funding source: debt and equity. And there is another funding source which is internally generated funds in the form of retained earnings. They are also available for investment purposes. So we have financing decisions. We have dividend decisions, right? So what we have done, we have borrowed funds or raised funds. Instead of borrowed, I would say we raised funds from the fund providers, maybe internally generated sources, so current owners, maybe through equity issue. So additional, it may be an IPO, it may be an FPO. If there's an existing company, it will have an FPO. Or it could be through debt. These money are invested in long-term assets and short-term assets. And these assets will generate the cash flows, the profits. And based on the profit generated, return generated rather, we will take what should be the dividend decision. Now the question is that why are we so much focusing on it? Of course, if I have taken money from someone, I have to invest it. And if I'm investing, I will earn return. If there's a return, then I will give dividend. So what is so great in it that we are discussing it? We are discussing it with a reason that whatever decision we take, there is one objective in mind, and that objective is wealth maximization. Should I give dividend? Should I not give dividend? If yes, I want to give dividend, then how much should be the dividend? In what form it should be? Should it be cash dividend? Should it be a kind of shares issued against them? Should it be interim? Should it be final? If I'm financing, then what should be my target leverage? Because on one hand, if I'm going for greater amount of leverage, I'm adding risk, but it will also create value for equity shareholders because it can earn more money. If my rate of return of the company is greater than the cost of debt, the additional amount available goes to equity shareholder. So their net worth will go up. So ultimately it will add to the value of the firm. What is the value of the firm? Value of the firm is market value of debt plus market value of equity. In India particularly, or the South Asian countries, we don't have a flourishing market for debt. So whatever has to be done, whatever policies has to be done to maximize equity. There is no flourishing market of debt, so market value of debt remains largely same. The changes are not that significant in the prices of the debt. So where the market value or market value of which component will affect the value, that's equity. So the company has to take policies such that the market value of equity is maximized. So what is wealth? The value of the firm will convert into wealth. And this whole total wealth will be distributed between the equity shareholder and the debenture holder. Because as per assumption, we are assuming these two are the source of fund providers. Even if you are using retained earnings, they also belong to equity shareholders. So even if you are doing it for internally generated sources, these internally generated sources are also of equity shareholders. Debt is contractual in nature. And everything is written in the debt indenture. What will be the rate? Whatever is your earning or not earning, you have to give the interest. So largely the things are given for debt, which does not vary throughout the life of the maturity. But for equity, it's residual in nature. So whatever actions you are taking as a manager, that has a direct bearing on it, because as we discussed in the previous class, the market value of equity depends upon what is the earning per share you are having and what is the price earning ratio that market is offering for the same. So your decisions must not only improve EPS, but also the quality of EPS. So if you increase EPS while taking greater degree of risk the market may give you a lower price earning ratio, and therefore the market value of equity may fall. All our decisions will be related to maximization of wealth. Now, the early days finance was more concentrated on this financing decision. And then the financier has a say in the decision making, interference in the decision making. So there was a need to think that the ownership needs to be separated from management. Or the job of the fund providers are to provide the funds, of course monitor, because it is their money which is getting invested, so it should not get it should not get wasted as well, because if the managers are not monitored properly, they will take decisions which will benefit them more as compared to the fund providers. But there is a separation that the fund provider and manager, these will be two different groups, theoretically at least. Practically, in most of the developing nations, the owners are the managers. They are having a significant amount of shareholding, so they can influence the decision making. Rather, they manage as directors or something else. So they are on the key managerial positions also. Then more focus was not only on, so early days financial management was related to procurement of fund. Later on it was said no, not only procurement of fund, but अब ऐसा नहीं वो इन्वेस्टमेंट नहीं करते होंगे, वो भी करते होंगे, but there were some issues with them. So not only procurement but also allocation. This allocation is your investment decision, right? And as manager, you are supposed to take these investment decisions in such a manner that the value for these finances are actually maximized. And if the value for these people are maximized, the value for the firm will automatically get maximized. Now these people are providing you cash, which has alternative usage. If it was not given to you as a company, it could have been invested elsewhere and it could earn some return onto that. So the money that they are giving does have some value. With opportunity cost, with reinvestment opportunity. And that brought the discussion of TVM, time value of money. We discussed some basic concepts of TVM or time value of money in the previous class. I hope you remember, but we have been given a very less number of classes, so practice a few questions on your own. And time value of money pe I'm not investing too much time, because I'm assuming that you people have done it well in BCom. If not, you can tell me and I will do a few questions on them also. There's no problem. And then there was another thing, cash flow. We will not take our decisions only based on accounting profit, but on the basis of the cash flow. I have given you my money to you. So in return, I want the money. Not the book profits, but the money. The book profit that you will report is subject to your decisions. It is subjective to your policies of depreciation, of inventory management, of credit management. I want my cash back because the cash that I have given to you, if you give me back cash, I can reinvest it elsewhere. The profits you could show me large profits, no problem. Book profits, accounting profits. But those profits are book profits, not necessarily cash. So now the focus shifted on cash flows. So if I have to evaluate a project, certain changes occurred from traditional to modern techniques. In traditional techniques, as you must be remembering, we used to have ARR, accounting rate of return, and payback period, PBP. Now, what was the problem with this? Accounting rate of return is based on accounting profit. So ARR, accounting rate of return, is equal to average profit during the assessment period, whatever the evaluation, if you are buying an asset for 5 years or 10 years, that means you are investing in an asset which has an expected life of 5 or 10 years. Then you calculate the average profit of that asset during this year and you divide that by average investment. That used to give you the rate of return based on accounting records. That is why we call them accounting rate of return, ARR. What the problem is? It is taking average profit.
Sir, can you please repeat yourself what you just said for ARR?
ARR, the accounting rate of return, is computed as average profit during the expected life. So if I'm buying an asset, let's for 5 years. So within 5 years, what is the average profit that is expected to occur? Divided by the average investment during the period. So this gives me a measure of profitability. A traditional technique, easy to determine the profits because it is directly, it can be taken from the accounting records. I know through accounts, your income statement, you can determine what is the profit of the year. You can estimate also. Based on them, you determine what is the profitability. Now, what's the problem? The problem is you are taking average profit. So profit of the year 1, profit of the year 2, profit of the year 3, profit of the year 4 and 5, and you're simply doing an average. That means you are giving equal weights to profits occurring at different points of time. What you will do? Let us take an example. Suppose You have taken an investment decision that will require 5 lakh rupee, and the profits reported required 5 lakh rupee. You have taken this decision and it required 5 lakh rupee. The profits that you were that realized were for the following: year 1, minus 20,000, year 2 50,000, year 3 30,000, year 4 70,000, and year 5 30,000, 35,000. And now the question is, what is your ARR? What is your ARR, accounting rate of return? There has to be a depreciation policy. This is an investment. So what you did, you use a straight line method of depreciation. You used straight line method of depreciation. For depreciation purposes, you used straight line depreciation. Let's have a few more information. The information says that in year 1, an unexpected fire caused a loss of rupees 25,000, and in year 4, there was a special assistance of rupees 35,000 from the government Now look what happens. This is what profits were reported. Minus 20,000, that is loss. 50,000 is gain. 30,000, 70,000 and 35,000. But two notable things are there. Number one, in year 1, there was an unexpected fire that caused a loss of 25,000. Now this is an abnormal loss and it needs to be adjusted. Otherwise, the profit reported is accounting profit that may not be well, for your decision making. And this is not expected to happen every year. So this is normal profit. We try to determine the normal profit. Then what it should be? A loss should be added on. So minus 20,000 plus 25,000, that is 5,000. Year 2 50,000, no problem. Year 3 30,000, kuch hua hi nahi. Let's have it. In year 4, there is special assistance received from the government. Do you expect such assistance to be received every year?
सर लॉस तो माइनस होगा ना 25,000 रुपए आपने 5,000
देखो
45,000 हो जाएगा
20,000 is the outcome. There was some profit from where this loss was reduced to determine a minus 20,000 profit. Right? Had this loss not been there, this is the final reported profit, right? Had this loss not been there, what would have been my profit? So it would have been
okay.
equal to minus 20,000 plus the loss amount. Is it okay?
Yes, sir.
Right. Because these are the final reported profits. In fourth year, there was a special assistance from the government. Now, this is also not normal activity. It happened because there was a special assistance. That's it. This is not happening due to the project that you took. This is happening due to some other forces which have no bearing on the project, and you want to determine the profitability of the project. So you need to control for these extraordinary items. So the reported profit here should be 25,000 net. Right? And then 35,000. What is the average profit?
So special assistance should not have been added.
See, you have been given a profit of 70,000 that's reported,
Oh,
right? So it says that you have 70,000. ये add करने के बाद की फिगर है, पहले की नहीं. So a normal profit plus assistance equal to 70,000. So how will you determine the normal profit?
okay.
Right. So now
Sir,
these seems to be
35,000
the
आनी चाहिए.
profits. These seems to be the profits. So let's have the average
Sir,
profit.
sir, year 4 profit will be 35,000 after subtracting the special
35.
assistance.
Yes. Thank you. So what is the average profit during this year? That you can determine the average profit by simply doing what? Sum these 5. Divide by the number. मैं डायरेक्ट एवरेज का फॉर्मूला लगा सकता था लेकिन मैंने किया नहीं. Divide by the number n. So we did sum the profits and divide by 5. This gives me the average profit. Now this means that the profit that is happening in year 1 and the profit happening in year 5 in money terms, they are same for me. Of course the quantum is different, but in the time there is no time value of money here. So these traditional techniques are also known as non-discounting techniques. Non-discounting techniques, because we don't use discounting and we don't give importance to time value of money in these techniques. As you can see here, we have determined the profit considering all profits in money terms to be same. So no importance given for their occurrence time period. 35,000 here and 35,000 here both are same. So I'm assigning equal weight to these cash flows. Average profit seems to be 31,000. Then what is average investment? Let's have average investment. What is average investment? And let us determine what should be the average investment here. Right? You have opening balance. You will have depreciation. And then you will have closing balance. Year 1, year 2, year 3, year 4. And let us assume the life of the asset is for 5 years because profit भी 5 years के लिए हमने. First year's opening balance, that is the investment that I am making, is rupees 5 lakhs. There is no information of scrap value. So this entire 5 lakh using a straight line method of depreciation will be depreciated to what? 0. So how do you determine the depreciation? Depreciation is equal to your investment minus, or let's keep it simple, cost minus scrap value or the salvage value, whatever you call it, divided by life of the asset. Here the scrap value seems to be 0. Chalo, for this, let's bring in the scrap value also. With scrap value of rupees 25,000. So there is a scrap value of rupees 25,000 also. Now, so what will be the amount of depreciation? It will be equal to 5 lakhs minus 25,000 divided by 5. That's the life. So every year 95,000 is to be used as depreciation amount. What should be the closing balance? The opening balance minus the amount of depreciation, that is the closing balance. What is average investment? Average investment is opening plus closing divided by 2. So opening plus closing divided by 2. Whatever is the closing balance of the next year, previous year, that will become the opening balance of the next year. And let me copy this to these places. And the closing balance of 5th year must be equal to 25,000. So 5th year closing balance is equal to 25,000. That's your scrap value. Your asset will be sold for this. And during this period, you have depreciated 4 lakhs and 75,000 rupees. So 5 lakh की asset थी, 4 lakh 75,000 depreciation, 25,000 your closing balance, total it makes what? 5 lakhs. What is your average investment? Average investment is average of these averages, annual averages. That's 2,62,500. इतना लंबा करने की जरूरत नहीं है. Let's have a simple formula. What is average investment? Average investment is equal to 1/2 of cost minus scrap value divided by 2 plus scrap value. फॉर्मूला समझने आया क्या हुआ? ओके, नो प्रॉब्लम. मेरे लिए इंपॉर्टेंट ये नहीं कि आप फॉर्मूला समझो, मेरे लिए इंपॉर्टेंट आप लॉजिक समझो. So focus on the logic, what and why we are doing like that. There are two components, cost and scrap value. So cost minus scrap value, if I say this is your depreciable value, this is the amount that will get depreciated. Right? So this is the opening balance, which will be depreciated over the period. and ultimately it will have at the end of year 5, it will have a value of what? 0. So something which has opening balance of this and closing balance of 0, what is the average? How do you get the average? The average is opening plus closing divided by 2. Opening balance plus closing balance divided by 2. Now look at the formula. What are written? Cost minus scrap value. This is your depreciable value, which will be depreciated over the useful life. So the opening balance is cost minus scrap value and closing balance is 0. So if I write this plus 0 divided by 2 is one and same thing as of it. Now why I added the scrap value? Be it year 1 or year 2 or year 3, year 4, year 5, any year. The scrap value is 25,000 is not depreciated. So remain invested here also, here also, here also, here also, and it releases at the end of year 5. So this amount does not get depreciated, it remains invested for all 5 years. So therefore, it is also part of your investment. Let's calculate it through this formula and let's see what is the answer. It is equal to 5 lakhs minus 25,000 divided by 2 plus 25,000, and this gives you 2,62,500. Same. So instead of doing this whole charting and tabulation, no need to do. Simply understand the logic. I don't remember this formula.
Excuse me, sir.
Yes.
Sir, I was not able to get the first half of the equation, cost minus scrap value divided by 2. Can you please explain it again?
Yes, I will explain again. Don't worry. और अकाउंटिंग रेट पे मैं ज़्यादा टाइम लगाऊंगा नहीं, क्योंकि मुझे जो करना है वो एनपीवी एनआरआर बहुत ज़्यादा है। इस पर क्वेश्चन भी कोई थ्योरेटिकल ही ज़्यादा आता है। चलिए देखते हैं। What is average? Average is equal to opening balance plus closing balance divided by 2. Opening balance plus closing balance divided by 2. Now, what is the opening balance? The formula that I have written here has two components. This formula has two components. Number one, this component from here to here is depreciable part, the part which will be depreciated, and this part is scrap value, which will not be depreciated throughout the life, will remain constant. Right? Now, the part which will be depreciated fully has an opening balance of cost minus scrap value. Which amount will be depreciated? Well, how do you depreciate? Depreciation is equal to cost minus salvage divided by life. This is what you write. So what are you trying to depreciate? The cost minus salvage. So cost minus salvage is your opening balance. Acha, at the end of the year, what will be at the end of the year? What will be the balance of this portion? This is depreciable, which will be fully depreciated to 0. So closing value will be equal to 0. So opening balance is, now opening balance is cost minus scrap value, and the closing balance is 0 because now the asset is fully depreciated except scrap value component. So the closing balance seems to be 0. So what is the average? Now you write 0. You don't write 0 if adding anything. Adding 0 in any number does not make any change. So average investment is what? Cost minus scrap divided by 2. This is the first part of my formula. The second part, scrap value added because throughout the life, this is the value which is never depreciated and remains till end, invested. And that's how we get, either you do it manually, year wise. This is the average investment of year 1, year 2, year 3, year 4, year 5, and take the average of averages. You will have average investment during the period, or you compute it this way, both amounts you are getting the same. Check kar lo. So now if you want to determine what is ARR, you can definitely determine it as equals to average profit divided by average investment multiplied by 100. That's accounting rate of return. So average profit divided by average investment into 100 and 11.81%. 11.81% is the accounting rate of return. Now, if my required rate of return is more than except this 11.81, if my required rate of return is more than 11.81, I will reject it. This investment is not worth taking. And if it is otherwise, then this project should be undertaken. Suppose expected return is 10%. Which return? In terms of accounting profit. And this is giving me 11.81%. Fine, take it. So decision criteria is simple, that if it is better than expected, except even this decision criteria is true for any method that you want to evaluate, any method. Another method is, now this is based on accounting profits, right? This is based on accounting profits. PVP, payback period, is based on cash flow techniques. So it requires that we determine what is not the profit but the cash flow every year. And this is also a measure of liquidity. It tries to determine how quickly if I take all these profits are cash profit except for depreciation, then how can I determine my cash flows? How do you determine the cash flows? First of all, let's determine the cash flows also. That how cash flows are determined. So you have sales revenue. From there you deduct your variable cost and you get to know your contribution margin. Right? From here you deduct your fixed cost. This fixed cost may be cash or it may be non-cash, such as depreciation. Depreciation is always a non-cash expense, but that's a fixed cost. Now what you got? You got profit before tax. So you deduct depreciation in order to determine what is your tax liability. Now you add tax from here. Get profit after tax. Now if I consider that these cash flows are cash, every other thing is happening in cash, then sales revenue minus variable cost gives you contribution margin. This may be cash, this may be cash, this may be cash. Here is one item as in the form of depreciation which is non-cash. I'm not saying that in fixed cost there cannot be cash cost. There can be. Rent of the building is fixed cost. Telephone rent is a fixed cost. And that's paid in cash as well. So I'm not saying the fixed cost cannot be non-cash or non-cash. I'm saying there is a possibility that there are fixed costs, and if you're taking a project, you will definitely depreciate it. By the way, what is depreciation? What is depreciation?
Sir, value decrease in the assets.
Value decrease in the assets. Okay. Who else?
Sir, normal wear and tear of the asset.
Sorry.
Sir, due to usage, the value of the asset decreases because of the wear and tear.
एक बात बताओ. You are buying a company's. You are buying an asset, 5 lakhs rupees. There are two companies, company A and company B. And the other is also 5 lakh rupees. दोनों ने same asset buy की same day. 5 years is the life. This company is using a straight line method, so the amount of depreciation is 1 lakh. 1 lakh. This company is using WDV method. This company is using written down value method and charging these depreciations. Just hold on. error आ रहा है इसके अंदर. चलो एक काम करते हैं. 20% straight line method. This is using 20% WDV method. Okay. So this one is using 20% WDV method, and this one is using 20% straight line method. So the amount of depreciation comes out to be this. ये हो क्या रहा है? एरर आ रही है इसके अंदर. तो एरर आ रहा है, चलो मैं देखता हूँ. 1,80,000 and now it's 180, 5, 320, 64,000. And then you have the further calculations. लास्ट का एक और कैलकुलेट करना होगा. G4 को कर दो फिक्स, बस आप कर देगा. नहीं कर रहा. राइट. अब मुझे एक बात बताओ, मेरा क्वेश्चन वही सिंपल है, कैलकुलेशन पे जाने की जरूरत नहीं है. सिंपल क्वेश्चन क्या है? You said that depreciation is wear and tear and something like that. यही कहा ना आपने? Fall in value of the asset due to wear and tear and this and that. Do you believe this company has more wear and tear and this company has lesser wear and tear?
सर बेसिकली डेप्रिसिएशन एक प्रोविजन होता है जिससे जब न्यू एसेट एक्वायर करें तो उसमें ये काम में आए, मतलब ये जो अमाउंट जो हमने एक प्रोविजन की तरह रखा हुआ है.
Sir, depreciation is a method wherein we allocate the cost of the asset over its useful life.
What's your good name?
Samansi.
Mansi. Mansi has given the exactly correct answer. When you make investment in capital goods also, and you make investment in revenue goods also. When you make capital assets, when you make investment in capital assets, then these assets are used for more than one accounting period. And whether you are buying a machine or you are buying raw material, both are expenses. And these needs to be charged to your income statement because these are expenses. You need to recover them. So what is depreciation? Depreciation is systematic allocation of cost of fixed assets over its useful life. So please remember, it is allocation. It is systematic allocation of cost of fixed assets over its useful life. The asset will depreciate, the market value will depreciate, that's fine. I would have asked, had there been more lectures there, I would have asked you number of questions on accounting over here. That is your balance sheet evaluation statement. What is difference between revenue and fixed expenditure, or the revenue expenditure or capital expenditure?
सर रेवेन्यू एक्सपेंडिचर बेसिकली जिसका
मैं
बेनिफिट हम
पूछूंगा नहीं बेटा, क्योंकि टाइम बहुत ज्यादा लग जाएगा उसके अंदर. आई कैन अंडरस्टैंड, बट मैं पूछूंगा नहीं. सॉरी, मैंने आपको बीच में रोक दिया. मैं कहा कि आई वुड हैव आस्क्ड, बट मैं डेफिनेटली नहीं पूछूंगा, टाइम बहुत लगेगा. सो यू नो दैट डेप्रिसिएशन इज ऑल्सो अ, हाँ वो प्रोविजन भी करते हैं कि इसको रिप्लेस. It is essentially allocation of cost of the fixed assets over its useful life. So this is allocation. That means due to this no cash is, due to this, no cash is going out. Neither cash outflow is happening nor cash inflow is happening. This much cash is available. So add back the cash, which is add back those expenses which are non-cash expenses, that is depreciation, and you get cash flow after tax. Till here you have studied only these. मुझे याद है बीकॉम में आपने ही रोक दिया होगा, right? Do you really believe that this much cash is available for investment? Do you really believe that cash is available for this much cash is available for investment? Yes, please. I hope I'm audible.
नो सर, इसमें से हम डिविडेंड भी तो पे करेंगे.
Dividend पे करेंगे. देखो, dividend is a different decision. Dividend does not have anything related to this. These three decisions are theoretically independent of each other. Practically नहीं है. Practically these three are connected. But theoretically these three decisions are independent. तो जब हम इन्वेस्टमेंट की बात करेंगे, वैसे तो आप कह सकते थे कि यहाँ पे इंटरेस्ट भी आना चाहिए था. Why you did not consider interest here?
Yes.
Because we are considering that in cost of capital.
So working capital requirement जो हमें अपने लिए.
हाँ बोलो प्लीज.
सर लाइक इन माय ओपिनियन हम इन पूरे अमाउंट को इन्वेस्ट नहीं कर सकते बिकॉज फॉर डे टू डे जैसे बोलते हैं हम एक्सपेंसेस के लिए हमें वर्किंग कैपिटल रिक्वायर्ड होगी, तो उसे भी हमें इसमें से करना पड़ेगा.
Right. To certain extent you are right. See what happens. Here you have assumed that entire sales revenue is in cash, entire variable cost is in cash, and therefore contribution margin is in cash. It may be true and it may not be true as well. भाई आप कितना सारा सेल किस पे करते हो? क्रेडिट पे. So your sales revenue is increasing, but at the same time your debtors are increasing and not the cash is increasing. So you adjust for adjustment for changes in working capital. You make adjustment for changes in working capital. अगर working capital बढ़ गया, if working capital goes up, that much cash is not available with you. So minus increase. Increase in net working capital. अगर working capital घट गया, so this much cash is extra available to you. So plus decrease in net working capital. So you make adjustment for changes in working capital. Right? Also, हो सकता है इस एसेट में 3 साल बाद, 4 साल बाद, 2 साल बाद एक कैपिटल एक्सपेंडिचर भी करना पड़े. तो जिस साल वो मान लो कोई आपने एक मशीन परचेज किया and it has a small component which has to be replaced after 3 years. So that's a capital expenditure you have to make. And if you do not make that, this asset will not be useful for the whole life.
Sir, then salvage value will also be there. कि अगर
Then
हम लोग सर salvage value, residual value भी तो होगी, वो भी तो हम ऐड करेंगे for the cash flow.
आते हैं उसके अंदर, वो एक अलग कैश फ्लो है. अभी तो हम एनुअल कैश फ्लो की बात कर रहे हैं, ठीक है ना? उसको भी यूज करते हैं. यू आर वेरी राइट. So that is called terminal cash flow. वो भी करेंगे. That also will consider. So after adjustment from changes in working capital, there is another requirement of capital expenditure, capex. एंड इसमें से जब ये दोनों एडजस्ट कर लिया आपने, whatever cash flow is available, that we also call them as free cash flow. So this cash flow is not tied to anything. This is free cash flow and this can be easily used for investment purpose. ये वाला कैश फ्लो होता है जो हम इन्वेस्ट करते हैं, बट हाँ, फॉर आवर स्टडी पर्पस वी जनरली कीप इट टिल हियर एंड वी अज्यूम दैट देयर इज नो चेंजेस इन वर्किंग कैपिटल. जितना इस साल क्रेडिट एक्स्ट्रा गया है उतना लास्ट ईयर गया था, वापस आ गया. सो देयर इज नो net change in working capital. If there is a net change in working capital, either increase or decrease, you need to adjust that also. So this is the free cash flow which can be reinvested, which is not tied with your own investment. And this is per year. Last year, there's the 5th year. In that, you will add one additional cash flow here, and that is scrap value. But this scrap value will be added only in what? Terminal year. सिर्फ यही नहीं होगा, इसके और एडजस्टमेंट्स भी होंगी ना. Is a scrap value, there may be tax liabilities also attached with it. So therefore, I'm not discussing it in detail here. I will discuss it in detail when we will have estimation of cash flows. चलो कर ही लेते हैं, अब इतना डिस्कस कर लिया तो कर ही लेते हैं, राइट? हाँ, let's do it, finish it. This is our per year cash flow, okay, or annual cash flows. There are two other types of cash flow also. हेलो, मैं क्लास में हूँ, क्लास के बाद बात करता हूँ. क्लास में हूँ अभी. So these are the annual cash flows. Every year these will happen. These are also known as subsequent cash flows. Let us understand how to determine initial cash outflow. Because we have to work on all the methods that we will be dealing with will work on cash flows only. So let us understand how will we determine initial cash outflows. Right? When you're planning to invest, what you are looking at? Number one, cost of the asset or the purchase price. Right? Cost or purchase price of the asset. In this, what you do, you add installation and other expenses. So simple enough. Like any expense that you made before this is put to use. Normal accounting concept. The cost price, installation expenses. If I bought a second-hand machine, then overall expenses, repair and maintenance expenses. Before once it is put to use, any expense made, that's form part of your initial cash outflow. Plus because of this asset, there may be increase in working capital, or if there is a decrease, then we reduce that. Decrease in working capital. Now, what does it mean? Let's understand. Before I go to this, एक question है आपके लिए मेरे पास. In Gurgaon, there is a plot of land that is valued 1 crore. You are the owner of it. %50 of the same is used for residential purpose. 50% of the same is used for residential purpose, and remaining 50% is available vacant, no use. There are bushes and people are throwing waste over there. Nothing, no usage at all. And you want to open a shoe company over there or a shoe outlet over there. So after I tell you the different components, I will expect you to answer me what should be the initial cash outflow. While other information given to you are the following. And this portion I'm deleting. So the other information related to shoe outlet is following. Number 1, land development cost. Land development cost will be, let's say, rupees 50 lakhs. ज़्यादा हो गया 50 lakhs, 20 lakhs. You have to construct a building that will require 2 crores. You will have to set up the plant. Plant नहीं, outlet खोलना है ना मुझे. हाँ. So fixed assets you will have to buy, and that will require 1 crore 30 lakhs. And you're supposed to tell me what is your initial cash outflow. But before that, working capital requirement. That is, you need to keep the inventory also, no? So you will have 1 crore rupee of working capital invested over there. So 1 crore rupee of working capital required will be there. And we're supposed to determine this cash, initial cash outflow. But before that, let us understand the different components of it. So if there is an increase, now understand, currently you are operating, let's say you are manufacturing 1 lakh units per year, and you buy a new advanced machine that will produce 1,30,000 or 1,50,000 units per year. Now your production capacity goes up. And because your production capacity goes up, you will have to hold more raw material. You will have to hold more finished goods. You need to have more cash to pay the wages. and meet day-to-day expenses relating to additional increase in the. So it's not that the previous required working capital is no more required, it's there. But because your production capacity has gone up, you need more investment than you already have. You need more investment than you already have. So this means you will not only pay the cost of the asset to the vendor, you will not only pay the installation expenses, repair expenses, the overhauling expenses, you will also invest money to buy more raw material, hold more cash. And what will you do if you produce more? You will have to sell more. And there is a probability that to increase sales, you are selling more on credit. So all three components will go up. It may be that they don't go up. How? Let's see. Suppose you bought a new advanced machine that will produce the same number of units produced, but it will consume lesser number of raw material. So earlier, your output input ratio was, let's say, 2 to 3. That means you were giving 3 units of input and you were getting 2 units of output. And now the advanced machine improves this ratio to 3:3. So now see what happened. Your level of operation is same. Because of this new machine, your cost goes down because the raw material cost goes down. At the same time, you would need lesser unit of inventories. Earlier, to produce 20,000 units, you need 30,000 units of raw material. Now to produce 20,000 units, you would need just 20,000 units of raw material. So there is a decrease in the requirement of raw material. So what I'm saying, there may be situations wherein because of this investment, your net working capital required is increased or your net working capital required is decreased. If it is decreased, reduce it. If it is increased, add as outflow. Now, there is a possibility that you already had a machine and you are going for replacement. So if you are going for replacement, then the old machine will be sold off. So you will be getting some cash inflow as a sales price of old machine. And that machine is getting sold because you are taking this decision to invest. I always look into two situations. Number one, what if I take this decision? What if I don't take this decision? If I take this decision, that machine is useless and it needs to be sold off. So that's also happening due to this, and therefore the sales price of old machine, rather let me write asset, which is a journal word, minus sales price of the old asset. So if you reduce sales price of old asset, now I am reducing. I need to pay this much outflow, this much outflow, this much outflow. But this much is coming to me. So I just need incremental amount. So you will always look for, now you remember the 4 things I told you. Incremental cash flow. You to this decision whether there is any incremental cash flow happening or not. So what is the amount that you need to pay out of your pocket? So out of your pocket is the difference only. But now there may be some tax adjustments also here. Some tax adjustments. Kaise? Let's see. You had old machine costed rupees 50,000. And you can sell it in the market for rupees, let's say 90,000. So this is the book value of the asset. And this is the selling price of the asset. This means you will show rupees 90,000 as negative amount. But there is a profit of rupees 40,000. This is capital gain. These are capital assets. So any gain earned on it is a capital gain. And if it is capital gain, there will be tax. So if 30% is your tax rate, 12,000 rupee you will be paying as taxes. So though you will have an inflow of rupees 90,000, you will have an outflow of rupees 12,000 also. And you are calculating outflow. So add tax on capital gain. Now it is possible that the book value was 1 lakh and it was sold for 90,000. So there is a capital loss of rupees 10,000. So if there is a capital loss of 10,000, this will reduce, or this will, decrease the total profit, and it will save taxes by rupees 3,000. So this 3,000 will also be taken as cash inflow. So 90,000 I will have selling price, and 3,000 I will save as taxes. So you add tax on capital gain and you subtract tax on capital loss. I hope you got the complete logic. This loss will decrease the overall profit of the firm. Had this not been there, I would have paid tax on rupees 10,000 more. How much I paid? I would have paid 3,000. So because I'm taking it, the loss is happening, my overall profit is going down, and therefore I'm saving 3,000 rupee of tax. So not only 90,000 cash is coming in, also indirectly it is saving a tax of rupees 3,000. Okay, what next? Whatever is the net amount, that is your initial cash outflow. This is your initial cash outflow. Right? Okay. Now, you tell me that the problem that I gave for the Gurgaon thing, I repeat, this is the value of the plot that you had, in Gurgaon. That's rupees 1 crore. 50% of the same is used for residential purpose, and the remaining 50% is useless. You're not using it actually. Useless तो कभी नहीं होता कोई चीज, but you're not using it right now. And you decided to open the shoe outlet. Tell me what should be your initial cash outflow. I hope I'm audible, right?
Yes, sir. Yes, sir. Audible.
No response was coming, na, so I just thought, let me ask. Please tell me, what is the initial cash outflow? I repeat the situation. You have a plot worth 1 crore in the market. 50% the same you have occupied for residential purpose. 50% of the other part of the plot is remaining idle, of no use right now for you. You decided to open a shoe outlet over there. That will require a land development cost of 20 lakhs. Constructing a building will require 2 crores. Fixed assets will be required by rupees 1 crore 30 lakhs. And working capital in the form of inventory and other thing, the shoes and all, that will require an investment of 1 crore. Now the question is, what is your initial cash outflow? And I told you to look into, okay, if I take this decision, what will happen? And if I don't take decision, what will happen? You just have to compare the two situations. I take a decision and I don't take a decision. Yes. Tell me what should be your initial cash outflow.
3 crore 50 lakh.
How much?
3 crore 50 lakh.
3 crores 50 lakh. What's your good name?
Ishita.
Ishita.
हाँ जी सर.
इशिता मुझे बताओ ये 3 करोड़ 50 लाख कैसा है आपका फिगर?
सर इसमें 1 crore में ये सारी चीजें ऐड करी, लैंड कॉस्ट, बिल्डिंग, फिक्स्ड एसेट्स और वर्किंग कैपिटल मैंने माइनस कर दिया क्योंकि वो इनफ्लो होएगा.
कैसे होगा इनफ्लो? अभी तो आपको शूज खरीदने हैं ना?
हाँ जी.
तो ये रिलीज नहीं हो रहा ना वर्किंग कैपिटल. ये वर्किंग कैपिटल तो जा रहा है हमारी पॉकेट से. इट इज इन्वेस्टमेंट.
अच्छा तो फिर इसको भी ऐड कर देंगे.
सर 4 करोड़.
सॉरी
सर
4 करोड़
ऐड कर देंगे.
क्या अमाउंट होगा? 4 करोड़ 50 लाख कितना होगा?
4 crore 50 lakh.
4 crore 50.
4 करोड़ 50 लाख. अच्छा एक बात बताओ, ये जो प्लॉट है मेरा, इसका 50% एरिया जो अनयूटिलाइज्ड है, उसकी कॉस्ट में इसमें इंक्लूड करूंगा कि नहीं करूंगा?
सर नहीं करोगे.
क्यों नहीं करेंगे?
सर क्योंकि वो तो मतलब हमारे लिए कॉस्ट है ही नहीं. वो तो हमारे पास ऑलरेडी एक्वायर है, मतलब उसे यूज कर लेंगे हम डायरेक्टली.
सॉरी
सर 50% हमारे पास अवेलेबल ही नहीं है, सो सिर्फ 50 लाख ही ऐड होंगे प्लॉट के.
तो 50 लाख इसमें ऐड होंगे, आप ये कह रहे हो?
सर हम उसको यूटिलाइज करें या ना करें, हमारा कोई इंक्रीमेंटल कैश आउटफ्लो नहीं हो रहा है क्योंकि वो आइडियली पड़ा है.
एब्सोल्युटली यही मैं आपसे कह रहा हूँ कि आपको यहीं पर फोकस करना है कि इफ आई एम डूइंग इट एंड इफ आई एम नॉट डूइंग इट, क्योंकि आप टोटल कॉस्ट डिटरमिन नहीं कर रहे हो. यू आर डिटरमिनिंग व्हाट इज योर इनिशियल कैश आउटफ्लो. दिस इज एब्सोल्युटली पार्ट ऑफ योर कॉस्ट and return should be appropriate to compensate for the same. I'm not denying that. It is part of cost, but it is not part of your initial cash outflow. You open a shoe outlet or you don't open a shoe outlet, this amount is a sunk cost. So a sunk cost does not have an importance in taking a decision. So I will evaluate my cash flows as against my initial cash outflow of 4 crores 50 lakhs. ये सही आंसर है. ये 50 lakhs का जो अमाउंट है, this is cost. I'm not saying it is not cost. It is not useless, but it's not incremental cash flow. By taking this decision to open the shoe outlet or not taking the decision to open the shoe outlet, this 50 crore amount will not have an importance or bearing on taking this decision. I hope you got it. The last type of cash flow is terminal cash flow. Sorry. So we have a terminal cash flow. Now what is terminal cash flow? So we have done 3 types of cash flows. These are subsequent annual cash flows. Generally inflows होते हैं पर outflow भी हो सकता है, no problem. These are initial cash outflows, and this is terminal cash flow. Terminal means now the asset has come to its end of the life. Right? So if the asset has come to its end of the life, then what will you have? Number 1, sales proceed of scrap. This will be your inflow, right or not? Last मैं इसके बाद आपको कॉल कर लेता हूँ. Sales proceeds of scrap, this is a positive amount. Now, if you are selling the scrap, you may realize more or less cash than the book value. Same वही वाला मामला. That you have book value of 25,000 in the example that we took. अब जब बेचने जाओगे उस साल, it could be sold for 30,000. It could be sold for 10,000. So if it is sold for 30,000, there is a capital gain, and if it is sold for 10,000, there is a capital loss. Gain है तो cash outflow, loss है तो cash inflow. So this will be minus tax on capital gain or plus tax on capital loss, depending on the situation. Also, the working capital which is blocked here, we assume that once the asset is put off the use, we will go back to the previous level. So at the previous level, whatever my investment was there in working capital, that was released. So add release of working capital. The working capital now is released, and whatever is the final amount, that is treated as terminal cash flow. I'm not saying that this will always be a negative amount or a positive amount. Depending on your asset, it can be negative, it can be positive. Right? So this is all about determining different cash flows. Now, how payback? Anything you want to ask, I'll give a time to. Yes, please.
सर आपने टैक्स ऑन कैपिटल गेन माइनस क्यों करा इन टर्मिनल कैश फ्लो?
ओके ओके ओके, देखो, you will sell the asset, so you will get sales proceeds. How much sales proceed you will get? ध्यान दो, ये जो बुक वैल्यू है हमारी एसेट की, वो कितनी है? जो हमने एग्जांपल लिया था, the book value is 25,000. और जब सेल करेंगे तो क्या मिलेगा? सेल्स प्राइस और सेल्स प्रोसीड. अब सपोज 30,000 इज द सेल्स प्रोसीड. फर्स्ट ये रियलाइज करते हैं कि 30,000 इज द सेल्स प्रोसीड. So you will receive 30,000. Up 25,000 ka book value, selling in 30,000. So there is a profit or loss?
Profit, sir.
Profit. This profit will increase the overall profit of the firm. क्योंकि sale, loss on sale of asset or profit on sale of asset, where do you report ultimately? Income statement.
Yes, sir.
So that will increase the overall profit of the firm, and therefore your tax liability will go up. कितने से? By the amount of 5,000. 25,000 the book value hai. Had it been sold for 25,000, no profit, no loss. Because it is sold for 30,000, there is a profit of rupees 5,000. So on this amount, there will be tax liability. So what is tax? Now this is tax on capital gain. The tax on capital gain is here 30%, that is 1,500. So what is the net amount you got? Received 30,000, but you paid 1,500. So ultimately the net amount available to you is 28,500. This is what I did. Okay, this is what I will receive and this is what I will pay. The net amount is my terminal cash flow. Is this point clear?
Yes, sir.
So anyone else who is willing to ask any question till here, I will happy to share. I will be happy to take the question. Otherwise, I'll proceed with the next type, which is payback period. Is my voice getting relayed properly without
No,
any
sir.
disturbance? Am I audible properly?
Sir, now you are audible.
So in between there's a problem, right?
Yes,
Yes,
yes.
sir.
In between there was
Yes,
a
sir.
problem.
Okay, okay. So now please remember now onwards that except the accounting profit, accounting rate of return, all other methodologies that we will be using now onwards, they all will use cash flows और अब real problems आनी शुरू होंगी. अभी तक तो base था. The modern techniques are the one, those are discounting techniques. Okay, so these are discounting techniques. And what are the discounting techniques? One is NPV, the mostly used, IRR, MIRR, profitability index, terminal value. These are commonly used methods of project evaluation that use discounted cash flows that give importance to time value of money. The real difference between traditional methods and the modern methods or the non-traditional methods are that these give importance to time value of money, where this misses themselves. So payback period, if I do this also based on cash flows, and these techniques are also based on cash flows. So largely there is no difference in cash flow and this payback period and these modern techniques, except the discounting of the cash flows. So what happens? We can also calculate payback period with the discounted cash flows, and that is known as DPBP, discounted payback period. Now let us understand what payback period is. Payback period says how quickly my investment comes back to me. How quickly my investment comes back to me. So it is measure of liquidity, which talks about how quickly your investment will come back to you. Let us take an example. At this payback period, I can finish today. We are calculating payback period. We have years 0, 1, 2, 3, 4, 5. Cash flows minus 5 lakhs. That's the cash outflow. So if with any cash I write negative sign, that means it is a cash outflow. A positive sign means it is a cash inflow, which has cash inflow of 70,000, 90,000, 1,50,000, 2 lakhs, and 2,50,000. There are two projects, project 1 and we have project 2. The cash flows are reverse in the sense this. Initially 1,20,000, two lakh 50,000, 1,50,000, 30,000, 2 lakhs and 30,000. Now look at the total cash flow here. Total cash flow will be 7,60,000 here and 7,50,000 here. Let us understand which project is more profitable for us. Let me change it to 3 lakhs. I want to show you something. Total cash flows, total cash inflow will be 8,10,000 in project 1 and 7,50,000 in project 2. The question is which project we are going to take. Okay. So what happens in payback period? We try to determine the years. We try to determine the years in which my investment is returned. It's not giving any value to time value of the money. It is simply trying to find out how many years will it take my investments to return. So let me find out cumulative cash flow. What is cumulative cash flow? Cumulative cash flow means we just keep on adding the next cash flow. So at the end of year 1, we will have 70,000. At the end of year 2, we already have 70,000 plus we will have cash flow the second year, that's 1,60,000. And if you copy it down, you will have 8,10,000 over here. Now look at what is your initial cash outflow, that's rupees 5 lakh. And I want to determine the time period within which my initial investments will come back. Now in this case, you look into year 1 is not sufficient, year 2 is not sufficient, year 3 is not sufficient, and year 4 end it is going overflow. So my payback period lies between third year and fourth year. It is between third year and fourth year. So how do you determine payback period? Payback period is completed years plus what is your initial investment? So how much is your investment minus what is the cumulative cash flow of completed year divided by the cash flow of the next year. That's very simple formula to understand. अब इसको ये लिखने में मत जाओ. Just understand what it is. 3 years is my completed number of years, right? Okay. 3 years is my completed number of years plus what is the investment that I made? 5 lakhs. How much amount has I've received in 3 years? That's accumulated cash flow in completed years. So in completed years, the total cash flow is 3,10,000. So the difference of 1,90,000 I have to receive from year 4 divided by what is the total cash flow accruing in this year? 2 lakhs. So what is my payback period? What is my payback period? It is 3.95 years. 3.95 years. So it takes almost 4 years to receive back my total cash flow. Simple. We first computed cumulative cash flows. We determined how many years I am taking to reach near to my investment amount. That's 3 years. Remaining amount I will receive from 4th year. In 4th year, total cash flow is 2 lakhs. And I need 1,90,000. So the ratio is 95. In total, I need 3.95 years. Same way, this is for project 1. I can do it for project 2 also. Equal to this equal to this plus this amount. Now bring it down. And total cash flow happening is this. What will be the payback period of project 2? So let us calculate payback period of project 2. Now for project 2, the completed number of years will be 2 because in 3rd year the amount is going up beyond 5,20,000. So the total number of years that I need to wait for completing is 2 years. So it's 2 plus. How much is the investment amount? 5 lakhs. How much is accumulated in 2 years? 3,70,000. Divided by how much is the amount that that is occurring in the year 3. In year 3, it is 1,50,000 which is occurring. So this should be my payback period. This should be my payback period. Which is 2.86 years. Now 2.86 years is much lesser than 3.95 years. And therefore, you may end up saying project 2 is better as compared to project 1. Payback period method is very easy to calculate. If suppose you invested 5 lakh rupee for 5 years and the cash flows were equal. Cash flows were, let's say, equal 1,20,000 every year. Rather, let's say 1.5 lakhs. 1,50,000 every year. 7.5 lakh ho gaya na? So every year you are having 1.5 lakh rupees. Equal cash flows. What will be the payback period? Very simple to determine. Investment amount divided by annual cash flow. Because it is same, equal. So no need to have a cumulative cash flow thing. वैसे भी करो तो same आएगा, but there is no need. You can simply say it is 5 lakhs divided by 1,50,000. So 3.33 years में मेरा amount वापस आ जाएगा. 3.33 years. That's your payback period. So calculation of payback period is quite easy. It takes care of cash flows. It uses cash flow to determine, and therefore it does not have to face the limitations of profits, accounting rate of return. It does not have to consider accounting profits, so free from personal or policy biases. But the problem here is it's giving equal weight to all future cash flows, whether occurring in year 1 or occurring in year 5. It is giving similar weight or equal weight to all these cash flows, which is not good. Which means there is no opportunity to reinvest these cash flows. And if there exists a reinvestment opportunity, then I'm missing on that. Number one. Number two, the limitation of this payback period is that it does not go beyond its payback period. For instance, post payback period, that is 2.87 years, this project is having very less cash flow, while this project is having very huge cash flow. But we are not giving any work to that. We are only considering cash flows which are up to 2.87 years or 3.95 years. So up to payback period. So it ignores the cash flows that happen beyond that period. Maybe this one is more profitable. I'm not saying it will be. I'm saying it may be more profitable than this one. So payback period also has limitations. It's easy to calculate, easy to understand, a good measure of liquidity. It wants to determine how quickly my investments will come in. So if I receive back my investments early, the risk is comparatively low. All these things are there, fine. But it suffers from the problem that it does not give weight to time value of money. Number one. Number two, it also suffers the problem that it does not consider the cash flows that arise beyond the payback period. So considering all these, we'll move now towards NPV. And why NPV is so important? Any question?
Yes sir. सर मुझे ये कंप्लीट कॉन्सेप्ट नहीं पता है. सर कंप्लीटेड इयर्स आपने कैसे कैलकुलेट किया, आप मुझे बता सकते हैं?
हाँ बिल्कुल बिल्कुल.
जी सर.
When you will calculate cumulative cash flows, अब क्या cumulative cash flow 70 and 90 160, 160 150 1 310, 310 and 2 lakh 510, 510 and 3 810. So these are the cash flows that are occurring over there. Throughout its useful life, it is occurring this much. Similarly, we calculated cumulative cash flow for project 2. So first year ka 120, up to second year we have earned 120 in first year and 250 in second year, so 370. Third year mein we have earned 120, 250 and 150, so 520 and so on. How much cash I need? 5 lakhs. So cumulative cash flow which is less than or equal to 5 lakh, cumulative cash flow which is less than or equal to 5 lakh is my completed year. So this 3,10,000 here and 3,70,000 here are the cumulative cash flows which are just immediately lesser than 5 lakhs. So in case this 3 years is the completed years, in case this 2 years is the completed years. the remaining amount of my investment, which is 5 lakhs. So in this case, remaining amount is 190, and in this case, the remaining amount is 130. I have to get it from next year's cash flow. So this year's cash flow is 2 lakhs. This year's cash flow is 150. So I need 190, that is this portion. 190 out of 2 lakhs. हाँ, एक बहुत इंपॉर्टेंट एस्पेक्ट है, या जो मेरे दिमाग से निकल गया बताना आपको. It assumes that cash flows accrue evenly. The cash flows have been distributed evenly. What does it mean? If in 1 year I am earning 3,60,000 rupees, then every month I am earning 30,000 rupees. That also means every day I am earning 1,000 rupees. So evenly distributed means you can distribute it to any subdivision, and that is equally available. For example, as my example, 3,60,000 is the annual cash flow. So if I want to compute it weekly, what is weekly cash flow? Now this is annual. This means monthly it will be 30,000. That's divided by 12. Daily it will be what? Daily it will be 30,000 divided by 30. That is 1,000. I am assuming 360 days a year, just for computation purpose, nothing else. Okay. So that means for weekly, it should be equal to annual amount divided by 52, because in a year there are 52 weeks. So 6,923 rupee is cash flow happening every week. So similarly, when in this cash flow payback period method, this assumption is very important, because if your cash flow is skewed towards beginning of the year or end of the year, then this portion will not give you the correct answer. This portion will not give you the correct answer. So this assumption is there, that the cash flows are evenly distributed. Yes, any other question please? I think for today it's okay, it's sufficient. Next है हमारा NPV, और यहाँ से थोड़ा सा टेक्निकल और थोड़ा डिफिकल्ट चीजें भी शुरू होंगी, बट आई होप आपको बेस एकदम क्लियर हो गया होगा अब तक. And now my speed will be a bit faster. So the coming classes will be a bit faster. I'll share questions through Pratibha. I've got her number, and we shall be solving problems on NPV and IRR in the next class. And उसमें देखना relationship क्या है NPV IRR का, और theoretically समझने की कोशिश करना. Right? Any question if you want to ask, please. You're welcome. Okay, so I shall take a leave. Thank you very much.
Thank you, sir. Thank you, sir.
Thank you, sir.
Thank you, sir.
आपको क्लासेस समझ में आ रही है कि नहीं?
Thank you, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
चलो ठीक है. Thank you very much.